For decades, the stock market had a strict set of rules. You studied balance sheets, calculated fair valuations, and managed risk. But lately, investors pulling massive returns aren't reading earnings reports. They're buying companies at 650 times earnings and dumping life savings into meme coins. These chaotic, internet-fueled strategies are currently blowing past the returns of seasoned Wall Street professionals. This leaves us with a question. Is the stock market permanently broken? Or is there a specific mathematical mechanic working behind the scenes that actively rewards reckless behavior? Meet Dave. Dave has been trading for 2 years. He just hit it big on a random crypto meme coin, and his confidence is at an all-time high. Following his big win, Dave calls his broker, lies about his net worth to get approved for options trading, and leverages his entire savings on out-of-the-money Tesla calls. His only risk management strategy is hoping the price goes higher. Yet, despite breaking every rule of finance, his portfolio is up significantly. Dave completely attributes this unearned financial windfall to his own personal genius. He sits directly on the peak of the Dunning-Kruger curve, where high confidence masks a total lack of knowledge. Dave isn't a financial prodigy. He has blindly stumbled into an environmental trap that, for right now, pays out heavily for financial incompetence. This chart shows the S&P 500's historical return. Since 2009, we've lived in a massive bull market, generating a 715% return. Under these conditions, buying almost any random asset generated a positive return simply by holding it. It is the equivalent of walking onto an escalator that is already moving up. Reaching the second floor doesn't require any actual climbing skill. When the entire baseline of the market only moves in one direction, raw profit numbers do not prove an investor's ability. They merely prove their participation. So why is Dave actually beating the market average? It comes down to his insatiable appetite for incredibly risky and volatile assets. In finance, there is a metric called beta. It's simply a measure of how volatile a specific stock is compared to the overall market. This chart illustrates beta. Amazon has a beta of 1.33, meaning it's 33% more volatile than the baseline market. When the overall market rises 2%, Amazon is expected to stretch further and rise 2.66%. Retail investors naturally gravitate toward these massive daily price swings. By loading up on meme coins and tech options, they accidentally build portfolios with heavily inflated beta scores. Put those pieces together. In a market environment that constantly rises, a high beta portfolio mathematically forces outperformance. The math does all the heavy lifting, tricking the foolish investor into believing they are a genius. But there is a critical catch to beta. The mathematical multiplier works in exactly the same way on the way down. Eventually, the escalator stops. The macroeconomic environment shifts, often when the Federal Reserve decides to aggressively hike interest rates. In a bull market, a high beta portfolio makes a day trader look like a legendary billionaire. But in a bear market, the complete lack of skill is suddenly exposed. When the broader market inevitably drops by a few percentage points, that high beta multiplier violently drags the risky portfolio down, wiping out gains in days. Because the retail trader never understood the underlying math driving their initial success, their sudden massive losses leave them desperate, searching for external conspiracies to explain where the money went. They will point fingers at market makers, politicians, or central bank chairs, blaming anyone but their own strategy. Surviving the stock market over a long time horizon requires strict self-awareness. You have to be able to honestly separate blind luck from an actual, repeatable strategy. Investors must recognize the historical environment they are operating in and remember the ultimate rule of modern finance. Everyone looks like a genius in a bull market. Let's talk about the bedrock